and price gets down into the lower end of the range, let's just think about this logically. Okay, forget about trying to make Fibonacci into this mystical experience. It's not. It's just pure logic. The market, if it gets down into this area here, doesn't it make sense that if people bought in this area once, that they're either likely to buy again, or that the mentality, the reasoning, the fundamental information, the technical information that caused people to buy, isn't it going to be the same information? I mean, look, this is not years gone by. This is 3 weeks. Unless the fundamental picture is massively changed, price is not going to just snap right through here. On a weekly chart especially. So the thinking, remember, what we are looking at as traders, in terms of price, is the result of individuals' thinking, their opinions. Their opinion down here was that the pound was not worth less than 88.36. It was worth more than that. And this is a huge move. Remember, trading is a thinking man's game. Don't just sit back and turn your brain off. You got to think about this stuff. So if traders were buying the pounds down in this 90.53 level to 88.36, if price gets down there again, it's probably going to reverse. And if it doesn't, what that tells me is there's been a shift in the underlying thinking of traders. So, practical application. So we're coming into the next week, 94.63. That's going to be a level I want to look at. Well, now let's find this on the chart here. 94.63 is right here. So now what happens? Okay, price comes down here. That's Sunday. Price comes down on Sunday. Starts to push up. Early Sunday morning, Eastern time, right around the London Open, look what happens. Price comes back down again. Can it get to the line? Absolutely not. Starts to move up. So we're starting to form this spike. So as we're planning ahead for the market, what are we doing? We're observing 94.63. What are we observing? We're observing it for reversal types of patterns. What are reversal types of patterns? Well, this W bottom is one, or a double bottom, right? A double bottom is a reversal pattern. There are many different ways to trade it. Some people like to trade above the middle of the W here. I prefer to go down to a 15-minute bar and trade like a 15-minute breakout. I like to look for different things like flags and pennants and whatnot. Okay. I also have this little dipper pattern, which I really enjoy. So if the market is coming down to a support level, I see it moving down again, I want to get in on it so I can make a trade if the risk reward is right. And the little dipper is based on just a simple combination of prior support or resistance has already been met and held, and I'm trading as the market bounces away from support or resistance, and I trade on the 618 retracement. And my stop is typically below the prior low, or if I'm trading to the upside, if the market moves down and up and I'm trading here, I'll trade above the prior high. Okay, that's an option. But don't miss the real meat of all of this past almost 30 minutes. What I'm getting at is, in order for the market to show you that it's starting to reverse, you're going to have to first develop a plan and an expected pattern. That's number one. Number two is we have to realize the basic underlying thinking. I don't even like using psychology. I think that's a very imprecise word. We have to understand the thinking that if traders were buying pounds down here and they're buying pounds in here, I mean, look at these 2 weeks. Closing nearly on the highs. Very, very bullish. Shaved bottoms. Very, very bullish. So there's major bullish sentiment in here. And then all of a sudden, 1 week, it turns around. So, We have to be prepared for this bullishness to come right back into the marketplace. So does this spike show us that it's likely that institutions are getting back in? I would say absolutely it's likely they're getting